my record. Okay, so this last 2 weeks, we're going to be spending on cash budgets. This week, we're going to work on net income approach. And then next week, we're going to do cash receipts and disbursements, which we're going to do 2 ways. One with credit card sales, and then one with credit sales. So using accounts receivable. So I'm going to share my screen. And I think what I want to do is just kind of first kind of go through the steps for the net income approach, and then we'll actually do a problem. So this week, your timing is going to be a little bit different. Your graded homework assignment will be due Friday night. And then Friday, so today we're going to do one in class, give you one to practice for homework, go over that on Wednesday, give you another one to practice, go over that on Friday. You'll have your graded assignment due Friday night, and then Friday we'll also start cash receipts and disbursements. And then next week, kind of the same thing. So, all right, so this is the net income approach. I'm not sure how much this is really used. In some cases, depending on the numbers, it just doesn't seem like, in my opinion, which doesn't mean much, but in my opinion, doesn't really give you a good handle on the cash. So what these cash budgets do is they take a company's predicted cash sales for the next 3 or 4 months and predicts what their cash balance is going to be. Sometimes they're just doing this to see where they stand. Sometimes they've got a big payment that they have to make in a few months and want to see if they're going to have enough money to do it. Sometimes they want to just buy something and want to see if they're going to have enough money. So whatever the reason is why we do these cash budgets. Now this one, just to scare you a little bit, is very similar to a cash flow statement because we know how much you guys like those. So this one, you're going to get a small income statement, and you're always going to start with the net income. And then you're going to make some adjustments, just like you do. Actually, let me do this first. We break this down into sources and then into uses. So this is kind of the basic setup. So the first thing, as I said, is that you're going to put the net income down, and you can put that all the way across because you're going to have several years to do. And so we're looking at this from a cash point of view. So similar to cash flow statements, the first adjustment we always made on a cash flow statement was to add back the depreciation. So the depreciation would be another source of cash. Because as you recall, depreciation does not require any outlay of cash. And so to get a true cash net income, we would have to add that back. And then you're just going to kind of have to go through the problem. So I'm going to put some stuff over here. So income tax expense. I'm going to put that there. I'm going to come back to that one. Actually, I want to do this one first. All right. So the other thing we're going to look at, just like we do with cash flows, is we're going to look at our current assets. Going back to cash flows. If a current asset increases, what was the effect on cash flow? Nobody remembers cash flow statements?
An increase to current assets would be a decrease to your cash flow.
Correct. Thank you, John. Okay, so then what about if the current asset decreases? Then what happens to cash flow?
Cash flow would increase.
Okay. All right, current liabilities. So if a current liability increases, what does cash flow do?
It increases.
Increases it.
And if a current liability decreases, what does cash flow do?
Decreases.
Okay, and so those are the same things that you're going to look at. If the account increases cash flow, it would be a source. If it decreases cash flow, it's going to be a use. And that's where they go. So sometimes with your current assets, let's say your accounts receivable, 1 year it increases, 1 year it decreases. So if that's the case, it would be here and it would be here. No parentheses, okay? If it's an increase, put it up here. If it's a decrease, you put it down here. Income tax expense is the one that you're going to have to look at, and you just got to read the problem and look at it. If it tells you that the expense is the true number, you do nothing. If they tell you that the income tax, let me stick tax in there. If they tell you that the income tax expense is book only, then you need to do two things. You need to add the income tax expense under sources. And you need to, number 2, put the tax liability under uses. So this will be very obvious because you're going to have a tax liability. So sometimes companies will do their books one way and taxes a different way. And a lot of that has to do with depreciation. They can do it one way on their books, but then they have to do it another way for tax purposes. And I was talking to a friend of mine who does taxes the other day, and now they've done something totally different with depreciation that he was still trying to figure out how to take care of it. Okay, the other thing here that you could have could be a bank loan. Down here, we could have the purchase. I'm going to put a capital purchase. We could have a distribution to the owners. Okay, anything that's going to make cash go out. You're going to add your total sources. Total uses. And then your next one is going to be your change in cash. And your change in cash is going to be your sources minus your uses. So if you spent more than you brought it in, then you're obviously going to have a negative number. That happens sometimes. Once you have the change in cash, you're going to take your beginning cash, which is usually given to you. You're going to add the change in cash, and that will get you your ending cash. And that's basically what you have with the net income approach. That's it. Questions? Okay. All right. So then turn to page 576. And we're going to look at number 13. And so we have a very condensed income statement. We have the net income, we have the depreciation. So if you look at the income tax, you'll see a little asterisk there. And this is how it identifies it. Tells you that the income tax expense is recorded on the books only. The amount paid each year is as follows. So this is one of those ones where we would have to do this and adjust it. If there's nothing, there's no tax liability or anything on the bottom, then you don't do anything with the income tax expense. That really is the only tricky thing I think there is to these. Is just making sure that checking out the income tax. Okay, so I'm gonna cheat here. Okay, so we have 3 different years here. And so the first thing you're going to do is put in the net income. So if we look at the net income, we have 300,000 for year 1, 300,000 for year 2, and 0 for year 3. depreciation expense is 500,000 every year. Okay, and then I'm going to go look at the income tax. So since that's not a real number, I have to add it back. So all I've done is just copy stuff. Okay, all I've done is copy stuff. So net income's on there, depreciation's on there. And because of the way this was written, the income tax has to be added. Only if you have a tax liability that you're going to go down in uses do you do this. All right, now let's go down to the bottom. Anybody have any questions on that part? All right, let's go down. So the first thing we're going to do is put in that tax liability. Because they told you that's what was actually paid. And remember, we're doing this from a cash point of view. And then let's look what else we have. Okay. Increase in accounts receivable. So every year accounts receivable increased. Is that a source or a use? Does it increase or decrease cash flow?
Increase.
Okay, so look up here.
would decrease
Right? Remember up here?
because people aren't paying us.
Increase in a current asset's going to be a decrease, so it would be a use. So you're just going to put down here. So an increase in accounts receivable would go there. Okay. Say refer back up here. Remember cash flow. If the current asset increases, it's a use because cash flow decreases. All right. What about an increase in accounts payable? Is that a source or a use?
A source.
Okay, because up here again, increase in accounts payable, current liability would be a source. So now instead of spending our money, we are keeping our money and buying on credit. Okay, then we have an increase in inventories. Source or use?
A
What
use.
kind of an account is it? It's a liability or an asset?
An asset, so it's a use.
Okay. So, yeah, 521. Okay, and then the last thing they tell us is the distribution to the partners. source or use? If you're giving money to the partners, is that increasing or decreasing your money?
It's a use.
Decrease.
It's gonna be a decrease, right? Because you're giving them money. Okay, and so that's all we got. So now we add things up. We're gonna do total sources. Total uses. Okay, and this one right here is why I think that I'm not so sure that this is really used that much. Because to find our change in cash, we're gonna go here. And we're gonna subtract here. And carry that across. I find it hard to believe that they're gonna have a change in cash of 740,000 when they only have sales. Well, they have sales of 5 million, but. Now this problem does not give you a beginning balance. But I'm gonna put one in just so you can see how it goes. I'm gonna put it down here because I know that you're gonna question where this number came from. And we'll say that they have, I don't know, 45,000. Okay. So what we would do then is take the 45,000.
The change in cash is from the total sources minus the total uses.
Correct.
Okay.
So we're gonna take the 45,000 that I gave you. We're gonna say that's the beginning cash. And this is why you'll see it's a little bit ridiculous. And then we're gonna add those two. So this becomes your ending cash. Now, if I end X1 with it, that means that I start X2 with it. And so here you can see how this one turns out to be a little ridiculous. I don't really think they ended up with $1,857,000 in cash. But so this is, some of the other ones are a little more realistic with numbers. But that I just wanted to show you because the one that you're gonna have to do for homework, you're gonna have to do that ending cash piece. And so once you find the change in cash, you're going to be given this number, add it, that gives you your ending cash, which becomes your beginning cash for the next year. Add them again, and that becomes your beginning cash for the next year. So I say, I seriously doubt a company's going to end up with that much money in their cash account. All right, so we're going to go through the steps again. And if you have any questions, ask. So the way that you approach these is you start with the net income. And no matter how complicated your income statements are, you only want the net income number and the depreciation number. By taking the net income number in, you've already taken care of everything else that's in the income statement. This is all you want. The income tax is going to depend on information they give you. If they tell you that the number on the income statement is the true number, you do nothing with it. If they tell you that it is book only, you will have a tax liability, and then you have to adjust your sources by that income tax expense. And then the liability piece goes down on the bottom. And you can see that there is a little bit of difference here. That's your estimated expense on the books. And your liabilities here. You actually had a tax liability even though you didn't have any income for that particular year. And then as far as other sources, and make sure you do this, if you have some kind of a capital purchase that you finance, you have to put the bank loan up here and the total cost of the project here. Students have a tendency to net them out. You can't. That doesn't give people a true picture of what's actually happening. So if you have a piece of equipment that you're buying in this particular year, you put that here. If you borrow half of the money, put it up here. Down under your uses, couple things, capital purchase, again at purchase price, and any distribution to the owners. Those would both be uses of cash. And then you're going to have to go through current assets and current liabilities. And I'm telling you, there better not be any parentheses here. If you have 2 that go here and 1 that goes here, you put 2 up here, 1 down here. They need to be identified as either sources or uses. In this particular problem we just did, they were all the same. But if we had a year where the accounts receivable decreased, that amount would go up here and it would be 0 down here. Just like cash flows, current assets opposite, current liabilities the same. In this case, a decrease is a use, an increase is a source. Once you have everything in here, you're going to add up your total sources, add up your total uses, find the difference between the two, sources minus uses. As long as you haven't spent too much money, you should have a positive change in cash. The change in cash is added to a beginning balance that would be given to you if you had it. The ending cash for the first year becomes the beginning cash for the second year, and so on and so forth. Any questions? The net income approach is definitely the easier and shorter of the 2 methods that we're going to do. All right, questions? Okay, I'm going to stop my share. All right, no questions. We're going to have a short day today. So your homework assignment is to do number 9, which is on page 574. Okay, 574. And that one has different Like your accounts receivable decreases 1 year and increases the other 2 years, and I would expect that it would be in both places. One where it's a source, one where it's a use. Questions?
That assignment, it's for Friday
Nope,
or for class
Wednesday,
Wednesday?
for class on
okay,
Wednesday.
Okay.
Yeah, we'll have a
Just
couple
number 9.
practice. We'll have a couple practice ones before we do an assigned. So it's number 9 on page 574. Okay, all right, have a good day.
Okay,
Good
you too.
Have a good
Bye.
day. Thank you.